Assalamualaikum warahmatullahi wabarakatuh. We are from Group 1 and we would like to present our discussion about inventory. So before that, I will introduce my group members. My name is Nazla Salsabilla and my group's members are Bintang Cantika and Fikri, Anwar, Rosyid. So we have analyzed company account balance on December 1st, 2017. So they have cash $4,800, account receivable $3,900, inventory $1,800, and equipment $21,000, and accumulated depreciation of equipment $1,500, account payable $3,000, and owner's capital is $27,000. So the first transaction during December, the first one is 3rd December, purchase 4,000 units of inventory on account at a cost of 0.74 per unit. The journals is merchandise inventory on debit $2,960. We got it from 4,000 units times 0.74. And in credit side, we have account payable with the same amount, $2,960. Okay, the next transaction is sold 4,400 units of inventory on account for 0.70 per unit. For 0.90 per unit, and it sold 3,000 of the $0.60 units and 1,400 of the $0.74. So here we have two journals. The first one is account receivable, $3,960 on debit, and sales revenue on credit side is $3,960. And the second journal is cost of goods sold, $2,836. We got it from 3,000 times $0.60 plus 1,400 times 0.74. The results are 2,836, and merchandise inventory on credit side is $2,836. Okay, the next transaction are granted this December 5th. Customers $180 credit for 200 units of inventory, return costing $120. These units were returned to inventory. So the journals is sales return and allowance on debit side $180, and account receivable on credit side $180 too. And the second journal is merchandise inventory on debit side $120, and the credit side we have cost of goods sold is $120. Okay, the next transaction is purchase 2,200 units of inventory for cash at 0.80 each. So the journals is merchandise inventory $1,760 on debit side, and cash in credit side $1,760. The last transaction is sold 2,100 units of inventory on account for 0.75 per unit. It sold 2,100 of the 0.74 units. And the journals are receivable $1,995 on debit and sales revenue $1,995 on credit. Cost of goods sold $1,554 on debit side, and merchandise inventory $1,554 on credit. Okay, digesting entries. The first one is accrued salaries payable for $100. The journal is salaries expense for $100 on credit and salaries payable for $100 on credit side. And the second one is depreciation 200 per month. So the journal is depreciation expense $200 on debit and accumulated expense $200 on credit. Okay, the next one will present by Bintang Cantika. Time is yours.
Okay, thank you, Nazla. So for the next instruction is prepare and adjusted trial balance as of December 31, 2017. So the trial balance is the analyst company trial balance after adjustment for December 31, 20 and 70 is the first one. There's cash and cash in debit. The amount is $3,040, and the account receivable in debit, and the amount is $9,675, and the equipment, the amount is $21,000, and there's account payable in credit side, the amount is $5,960, and there are owners capital in credit side. There are salaries payable in credit side, the amount is $400. Owners capital in credit side, the amount is $27,000, and there are salaries expense in debit side, the amount is $400, and sales revenue in credit side, the amount is $5,955, and then sales return and allowance in debit side, the amount is $180. Merchandise inventory in debit side, $2,250. Cost of goods sold in debit side, the amount is $4,270, and depreciation equipment in credit side, the amount is $1,700, and also depreciation expense in debit side, the one is $200. Uh, and the next instruction is prepare an income statement for December 2017 and classifies balance sheets and at December 31, 31, 20, and 17. So the income statement first in here for the month December 31, 2017. So in revenue, there are sales revenue and cost of goods sold. the amount of sales revenue is $5,955, and we less it with cost of goods sold. The amount is $4,270, and we got the gross profit, which is $1,685. And the expenses, there are operating expenses is salaries expense and depreciation expense. Salaries expense is the amount is $400, and we ate with depreciation expenses. The amount is $200, and we got the total operation expense, and the amount is $600. And we less the gross profit with operation expenses, and then we get the income before tax. The amount is $1,085. And next, the statement equity change for the month December 31, 20, and 17. So in this statement of equity change, there are owner's capital on December 1, 2017, and the amount is $27,000, and we add the income before tax. The amount is $1,085. So we get the owner equity on December 31, and the amount is $28,000 and $85. So the next one is balance sheet. So the balance sheet one of January 31, 2017. So in Activa's side, there's a set like cash, account receivable, equipment, debris equipment, merchandise inventory, and sales return and allowance. And cash, the amount is $3,040. Account receivable, the amount is $9,675, and there are equipment. The amount is $21,000, and we less it with account accumulation depreciation equipment. The amount is $1,700. So the we get $19,300. And merchandise inventory, the amount is $2,250. And sales return and allowance, the amount is $180. And the total assets, we get $34,445. And on the passive side, we get account payable. The amount is $5,960. Salaries payable $400. Owner's capital to $28,085. And we add that and get total liabilities and equity is $34,445. And that's all for me. We back to Nazla. Thank you.
Okay, so thank you very much, Bintang. And the next one will presented by Fikri. To Fikri, time is yours.
Okay. After that, we can compute ending inventory and cost of goods at Vivo and Livo, assuming an analyzed company use the periodic inventory system. Okay, in the inventory system, on the Vivo one, cost of good available for sale. On the first date of December, in beginning inventory, we have 3,000 units. And for the cost per units, we have $60. So 60 times 3,000, we have the total one is 1,800. Okay, the next one is on the 3rd December, we have purchase. We have 4,000 units, and for cost per units, we have $74. And $74 times 4,000, we have the total is 2,960. Okay, the next is 7 December purchase. We have 2,200 units, and for cost per unit is 800, 800, $80. I mean, okay, $80 times 2,200, and the total is 1,760. Okay, the total of goods available for sale, the units is 9,200, and the total cost is 6,520. Okay, the next is goods sold. On the 5th of December, we have 4,400 units. On the 7th December, sales return and all loans, we have minus 200. On the 22nd of December, we have sales on the unit. We have the unit is 2,100. Okay, total goods sold is 6,300. So in ending inventory, 9,200 minus 6,300, we have 2,900. Okay, in the ending inventory on the first of it's now is $6, and the total cost is on the 3rd December, we have 700 units, and for cost per units, we have $74. And for the total is $518. Okay, then the next one is 70 December. On the 70 December, we have the units is 2,200 units, and for cost per units, we have $8. 8 times 2,200, we have 1,760. And in the inventory, for the units, we have 2,900. And for total cost, we have $2,278. And for the cost of goods sold, we have cost of goods available for sale. We have 6,000, and less in ending inventory, we have 2,278. And for the cost of goods sold, we have $4,242. Okay, on the Livo one, cost of goods sold, it's the same one for on the Vivo. Okay, in the 1st December, in the beginning inventory, we have 1,000 units, and for cost per unit, we have $6, $60. 60 times 3,000, we have 1,800. Okay, the next one is this 3rd December purchase for 4,000 units, 70, and for cost per unit, we have $74. 74 times 4,000, we have 2,960. And the 17 December purchase, we have 2,200 units, and for the cost per unit, we have $18. 18 times 2,200, we have 1,790. And the total of goods available for sales, we have $9,200 and $9,520. On the goods sold is same one in the Vivo. We have 5th December, we have 4,400 units. And the 7th December, sales return and allowance, we have minus 200. And the 22nd of December, we have sales, we have 2,100 units. And total goods sold, we have 6,300 units. Okay, in ending inventory, we have 9,200 minus 6,300. We got 2,900 inventory. Okay, in ending inventory, we have the first date of beginning. We have 2,900 units, and for cost per unit, we have $60. 60 times 2,900, we have the total is 1,740. Okay, on the 3rd of December, we have 0 units, and the forecast per unit is $74, and the total is 0. And the 7th of December, we have 0 units, and the forecast per units we have $80. We have the total is 0. Okay, in the ending inventory, we have 2,900 units, and the total is 1,740. And the cost of goods sold, cost of goods available for sale, 6,520, and the less in ending inventory, we have 1,740. And cost of goods sold, we have $4,780. Okay, that's all for me. Continue to Nazla.
Yeah, thank you very much, Fikri. The last one. I'm sorry, I forgot to explain this. We have T account. This is our T account for the transaction. Here, the cash, merchandise inventory, account receivables, account payables, equipment, owner's capital, accumulation of depreciation equipment, depreciation expense, cost of goods sold, and sales revenue, sales return and allowance, salaries expense, and salaries payable. I'm sorry, I forget to explain that. So that's all from us. Thank you very much for your attention. I'm sorry if there is any problem or mistakes. And Assalamualaikum warahmatullahi wabarakatuh.